Assalamualaikum. Welcome to lecture 5 of tax. So in my previous lecture, lecture 4, I have discussed the employment income. This is the continuation of that. So this is going to talk about the employee benefits and the payee system. This lecture is very important for your tax exam because 101% you are going to get a question on benefits. There are a list of benefits. There are some, I think around 10 benefits, and out of those 10 you will get 2 to 3 benefits you will be asked in your tax exam, and this will not only help you in tax but also as well as ATX. So make sure that you know these rules. There are various rules under various benefits, so this lecture is going to be a little lengthy, okay, because we are going to have lots of questions for each type of benefits. Now let us start. So here we are going to focus on the summary of benefits, the exempt benefits, the benefits which are not chargeable to tax. It's very important that you have to know those benefits also, because in your exam, when you are given a question, they will not only give you benefits which are taxable, they will also give you benefits which are not taxable in under one list. You have to identify which are exempt, which are not. Then assessable benefit, benefits which are taxable. Cash equivalent value. Sometimes some benefits you have to find the cash equivalent value of that. How do you find that? There are 3 ways. We'll see that. Then, summary of benefits accessible on all employees. A summary of it. So these are the benefits. Starting with number 1, living accommodation. When you are being provided a living accommodation by your employer, it's a benefit for you. On that you are taxed the amount that you are receiving. Then job related living accommodation. Then vehicles and fuel for private purpose. Loans and interest free loan. Use of assets, you're using an asset other than vehicle, fuel, accommodation and loan. Transfer of used assets. All these are benefits. Moving on to PAYE. What is the scoop? Tax collection at source, the notice of coding, weekly or monthly procedure, the real-time information, the pay penalties, year-end procedure, payrolling benefits, employees changing employment. Then finally, we are going to see how much of the syllabus we have covered. We are going to summarize the entire lecture and the technical articles. What are the technical articles? You have to read for this lecture. Now, so this is the graphical representation, the pay and the benefits. Okay. Now, main objective of this lecture is to know all the detailed rules of assessing your benefit from employment and understand how the pay system works. Remember how the pay system works. This is only for tax. In ATX it will not be asked because you are going to get multiple choice questions for 30 marks. So there they could ask this, the pay system. Okay. Now, so there are 2 classes of benefit: exempt benefits, we'll see section 1.2, and benefits which are taxable. Most of the time all benefits are taxable and you have to assess the cash equivalent values. We'll see in section 1.4. Now, the exempt benefits, job related accommodation. Section, you have to see section 1.7 for detail of this. But job related accommodation exempt. If you are receiving a canteen, subsidized canteen, and it is available to all the staff, it's an exempt. If you are receiving removal expenses, that means you have been removed by an employer and you are being paid up to 8,000, it is exempt. That means even if you're receiving 6,000, 4,000, exempt. See, more than 8,000 they will not give you. Okay, mostly they will limit it to 8,000 because excess is taxable. But since we don't know the rules of how it is going to be taxed, they will not give you more than that. They will give you up to 8,000 only. The removal expenses up to 8,000 exempt. This is your relocation cost or for moving. Next, incidental personal expenses paid by the employer. Let's say an employee is supposed to stay overnight on company business. So if you are staying up to £5 per night in UK, 10 abroad. Okay, double it when you are in abroad. So telephoning home, newspaper, laundry, all this will come there. If your amount received is more than 5 or 10, the whole amount, not the excess. See, sometimes only the excess is taxable. Like rent a room relief from my previous lecture, investment income. Rent a room, excess more than 7,500 is taxable. Here, whole amount is taxable. If it's let's say 12, the whole 12 is taxable. Okay. Then travel benefits. Travel benefits means any benefits not costing more than 50 per employee. For each employee, the benefit is less than 50. As you are receiving a mug or a pen, the amount of this is less than 50. These are known as travel benefits, very small benefits. They are exempt. Okay, usually they are given for non-work reason. They are not in the form of cash or cash voucher. Okay, that's a company mark or a calendar or a pen. If we take it in terms of money, amount is less than 50, but they are not giving you cash or cash voucher. If you have been provided with a parking space at your place of work, exempt. If you are using a pool car means where everyone is sharing the car and using it. You have to see section 1.8, exempt. If you are using a van, unless there's a private use which is significant, okay, section 1.8 will cover the van, exempt. If you have been given workplace nursery provision, exempt. Contributions by employers into pension schemes. Since they told pension scheme, it could be any pension, private or personal or occupation. Then sports and recreational facilities for all the staff. Then outplacement counseling services to employees after being made redundant. If employees are being made redundant and you are giving them some counseling services, that is exempt benefit. Employee liability and indemnity insurance, exempt. Staff parties, provided the cost per head is not more than 150, exempt. Small loans. Small loans mean any loan under 10,000 in total. 10,000 in total means not one loan in 10,000. You are giving let's say 3, 4, 5 loans. All together, if you add up, amount is less than 10,000. That is known as small loans. It's plural, not loan. From an employer. We will cover this in section 1.9. Then, if you are giving one mobile telephone, exempt. Then, provisional work buses, public bus, bicycle safety equipment, exempt. But if it's a private car, not exempt. Okay. Then non-cash, long service award. Let's say you have been awarded for working at least 20 years. And the cost is not more than 50 per year of service, exempt. Hospitality and other non-cash gifts that are received by the virtue of employment from a third party. That means because you are into that employment, you are receiving this non-cash gift but from a third party. But the total value of the gift from one source should not exceed 250. And the gifts are not made in recognition of the further career service. That means the gifts are not because you are performing a certain duty in your employment. It is just simply given. Exempt. Travel expenses, where let's say public transport has been disrupted. Okay, let's say a late night journeys are required, or a car sharing arrangement breaks down. That's why traveling expenses are exempt under that condition. Entertainment for employees by third parties. Let's say seats at sporting or cultural event, exempt. Cost of work related training, exempt. Provision of staff uniform and protective clothing for work purpose, exempt. Routine health checks and screening, vouchers for eye test and corrective spectacles for video use, medical expenses up to 500 per year. Okay. Awards under staff suggestion scheme that is available to all employees. So here This is up to 25 for encouragement award, up to 5,000 for suggestion that will save or make business money. Exact. So I know the list is pretty lengthy, but once or twice if you read it and if you're given the questions in the exam, you will know what is exam, what is not. Then benefits which are accessible. Accessible means they're taxable benefits. So it does not matter what is the employer's remuneration. Once you receive a benefit and if it is taxable, you have to know how it will be assessed. Okay. In this case, if you have been receiving a benefit, all employees will be receiving P11D. You have to remember this P11D form. Unless you are payrolling the benefit. Payrolling the benefit means you are converting the benefits to cash. We'll cover this in section 2.6. Now, cash equivalent values. There are three ways. First is we'll see what is the cost to the employer. Okay. Let's say an employer is buying an asset. So at what cost the employer is buying that asset for? Or when they are paying the expenses to employee. Okay. Usually the cost to the employer is the full cost. But it may be less than the amount that the employer would have paid for the same goods or services. If an employee is to pay, they would have paid lesser than what employee is paying. So I'm sorry, employer is paying less than the employee. Why? Because employer is getting an advantage of bulk discount. Now, where the goods and services provided are those that are normally sold to the customer, the cost is only the marginal cost to the employer plus the VAT based on the normal selling price. Let's say the cost of providing a place at fee paying school for the child of a teacher employed at that school. Now, second, you see the annual value. So this basis applies where assets are made available for use to an employee with ownership retained by the employer. That means ownership is with the employer, but employer will be using it. Let's say company car. Who is owning it? Employer. Who is using it? Employees. Accommodation, loans and beneficial terms. These are the three benefits which we are going to study in detail later on in this lecture. This three uses the rule of annual value. Okay. Now, so cash equivalent value based on an annual value is restricted on a time basis. Remember, if it's an annual basis, you have to use the time basis. For example, into n divided by 12, where the asset is not available. If your asset is not available for a complete tax year, you have to portion it for the number of months it was made available. This is if it is based on annual value, not the cost to the employer. And the third, contributions by the employee. Sometimes employer also contributes towards a benefit. In this case, whatever the benefit that an employee is receiving will be reduced by the contributions employee is making. Okay, but there is one rule, one exception, that is the provision of fuel. When we go through fuel, car benefit, this rule is different. Here, even if the employee pays for the private mileage, still you can't deduct it unless you pay for the whole amount. Partial, let's say partially you are paying, that partial payment is disallowed. Either you pay for the full amount, either you don't pay at all. This is for the employees. Okay, this is provision of fuel for both company cars and vans. It works for both. So you can only reduce, an employee can only reduce this for the cost of fuel if they fully pay for it. Otherwise, no. So this is the benefit, each benefit, and this is their cash equivalent value. First one, living accommodation, excluding ancillary expenses. It does not include the other expenses, only the cost of the home. So we'll see section 3.3 and 3.4. Vouchers exchangeable for cash, redemption value. Vouchers for goods and services. cost to employer, use of credit cards, cost of goods services and cost of goods and services purchased, and cash withdrawn. Discharge of an employee's personal liabilities by the employer. That means employee's personal expenses are paid by employer. Let's say their domestic household costs are paid by the employer. Okay. So identify with business calls. Let's say on your telephone line, you identify clearly that this is your business call. Accordingly, employees will pay for it. So this is also cost to employer. Then cars and van and fuel annual value. You'll see section 1.8. Loans cost to the employer, section 1.9. When written off. Okay, annual value. So the interest benefit is the annual value. Section 1.9 again, use of other assets. Remember, this other assets will not include living accommodation, loans, vehicles, or fuel. Why? Because for them we have other rules. That's why. Other than that, any other asset, let's say computer, take 20% of the cost of that, cost to the employer. We'll see section 1.10 for it. Purchase of assets on behalf of employees. When it is new, when you're first time buying the asset, it is the cost to the employer. When it is second hand, it depends on the type of asset. We'll see section 1.11. And purchase of services on behalf of employees. Let's say you're purchasing private medical insurance, cost to the employer. So you need to remember cash equivalent value for all those benefits. First benefit, living accommodation. Here, an employee is being given a living accommodation. But if it's job related living accommodation, exempt. So benefit has three elements. First, the annual charge. An annual charge is higher of your gross rateable value or rent paid by the employer. We'll see there are two notes for it. And two, additional charge. So annual charge, with that you add additional charge. This usually comes when your accommodation is more than 75,000, and in your exam they will always give you an accommodation which is more than 75,000. How do I know? Just check the past paper. They will always give you that, because then they can check your knowledge on this additional charge which you have to add with the annual value. Okay, we'll see note. If you're owning it for 6 years or less before first being made available, this is how you check. Okay, if you're owning for 6 years or less than that before being first made available, then this is the charge. Take the cost will be given to you, deduct 75,000 from that always, and the official rate of interest at 6th April. This official rate of interest will be given to you in your exam. If you are owning it for more than 6 years before being first made available, this is the charge. Take the open market value when first made available and deduct 75,000 into official rate of interest. The only difference is if it's owned 6 years or less, you take the cost, and if owned more than 6 years, you take the open market value when first made available. Rest everything remains the same. And note, the cost of improvement since accusation, but before the start of the current, is added to the cost or open market value. Remember, cost of improvement, if it is before the start of your tax year, current tax year, you can add it to the cost open market value. But improvements after the tax year are ignored. Even made after the start of the current tax year. Now, the third element, ancillary expenses. Ancillary expenses are your utility expenses like gas, electricity, and water, council tax, redecoration, wages for domestic help paid by employer. So what is the charge? The charge is cost to the employer. So cost to the employer, we deduct the contribution by the employee, and that is the benefit. Now, Remember, there were notes when we were calculating the living accommodation. Note 1 were the annual rates. So the gross rateable value, this will be given to you in the exam. Okay, that is your annual rental value of the property. Then 2, rent. Rent will be paid by the employer if it is not owned. This they will give you. Okay, the question will tell you whether it is rented or it's owned. If it's owned, rent will not be given, and if it's rented, they will give you the rent. Now, so the additional charge only applies to properties owned by the employer. That means there will be no rent. Okay, because if the property is rented, it will be the rent paid by the employer that will be equal to your current rateable value. So additional charge is unnecessary if you logically think about it. Now, third, the official rate of interest. This will be given to you. Now we will be doing activity 1, where we'll be calculating the accommodation benefit. So you have to calculate the assessable benefit assuming the official rate 2.25%. So company purchased a house in 2020 for 150. Capital improvements were made 2021. Costing 10,000, again in May costing 20,000. Now they moved into house in Jan 2022 when the market value was 205. Its value on 6th April 2024 had fallen to 185. The gross rateable annual value is 1,000 and nil is to pay 100 a month towards the provision of the house. So you have been given some electricity. Okay, expenses, electricity, cleaning, structure repairs and council tax. So now let us solve activity 1. So activity 1. The first information that we need is the annual value. And if you see the annual value, okay, they have already given you, it is 1,000. So we are going to write it here. Annual value AV 1,000. Next, the additional benefit we have to add. Additional benefit AV. Okay. So when we are writing the additional benefit, what are we taking? When we purchase, see, we have purchased it 20, okay, and it is 24.25. So it's within 6 years. Okay. So we are using the cost 150. With this 150, we can add this 10,000 capital improvement because it was before the tax hit 24.25. It was in 21. But this 20,000 we can't use because it is in the year 24-25. It is in May 24 after the tax year. So we can only take 10,000. So it is 150,000 plus 10,000 minus 75,000 into the official rate. The whole thing into official rate. What is the official rate? 2.25%. 2.25%. Done. This I'm going to round it up. Let's put a minus. Done. First term. Okay. Now copy, paste. Now we are going to take the ancillary expenses. So what are the expenses? Electricity, cleaning, maintenance, council tax. Okay, minus electricity, cleaning, maintenance, council tax. But what about the structural repair? Why aren't we taking the structural repair? Because this is the cost to the employer. It is the cost to the landlord. Landlord has to incur this cost. It is not an employee. The structural repair. So this you can't take. It's a capital expenditure. You can't take it. So only the electricity, cleaning and council tax you can deduct. So electricity minus 540, cleaning 1572, and council tax 1200. Done. So take the sum function of this. Again take the sum function. Remember this you have to add. It's not minus. Let's do the sum function here. This is plus. Okay, you have to add all this. These expenses you have to add with this annual value and the additional benefit, because this expense is also paid by the employer with this. So this will be added. This will round up. Now remember, any contributions by nil will be deducted. So what is the contribution by nil? He is paying 100 per month. So it's 100 into 12. Because this contribution by nil, the employee, it will be deducted from the benefit. Now we'll round this up. We'll go to custom and 0. Okay. So 5025 is your benefit. Now moving on to activity 2. Activity 2, you have to calculate the same benefit, but now the house was acquired in 2013. So it's more than 6 years. So how this will change? Annual value will remain the same, but your additional benefit will change. Here it will be 205,000. Now you have to take the open market value, not this 150 and plus 10,000 capital improvement, because it's more than 6 years. You have to take the open market value. So this is the only change that will take place when it's more than 6 years. So now it's 205. Done. Everything else remains the same. Expenses will be same. This still employee contribution you have to deduct. So now your benefit is 6,037. And remember, there was a market value given 2024, right, to 185. This is irrelevant. It's not required. So this is the answer for activity 1, where we got 5025 as the value of the benefit when we purchased it within 10 years. We have took the purchase price with capital improvement, which was in 2021, not the later improvement. And then we have took the ancillary expenses. We did not take the structural repair as it is with the landlord, and we deducted the employer's contribution and got this. In the second scenario, activity 2, it was acquired 6 years before, more than 6 years. So we have used the open market value. This is the only difference. Everything else remains the same. And market value on 6th April 24 is irrelevant. Moving on to the next. So from living accommodation, we are moving to job related living accommodation, as we know that this is an exempt benefit. Okay, job related means because of your employment, this accommodation is provided. Either it is necessary for you to perform proper duties, or it is customarily provided for better performance, or for special security reasons. One of the 3 reasons. Now, if accommodation is job related or not, they will tell you in the question. These examples are included for your understanding, like houses for church clergy, houses for nurses, an apartment with an apartment block or caretaker, All these are job related accommodation. Now, this is favorable in terms of tax. Why? See, living accommodation, just now we have calculated the house annual value with additional charges, where if the value was more than 75,000. But if it's a job related, both your annual and additional charges are exempt from income tax. Council tax, water charges, exempt. Now, what about the ancillary expenses that are paid by employer? These are taxable, but the ancillary expenses cannot exceed 10% of the employee's net emoluments. What does it mean? All your pay and benefits, excluding the accommodation, less all your allowable expenses. So, in the view of net emolument rule, when you're dealing with questions involving job related, the calculation of this benefit should always be done last. Remember, job related accommodation. This benefit should always be calculated last. Now, activity 3. So, activity 3 will help you to understand this better. Facts from activity 1. Okay, now that from accommodation it became job related accommodation, and Neil is not paying 100 per month. That is, that 1200 that we deducted there no longer applicable here because it's not paying. Now he has annual salary of 25,000, taxable benefit of 170, pays occupational pension contribution of 4950. So now calculate his benefit. So remember, if it's job related, even if annual amount and additional charge are exempt, you have to write it like this. You're going to get 1 mark for this. Annual value exempt, additional charge exempt. Then benefits, ancillary benefit. First, so what were the cost? Except the exempt council tax. There were 3: electricity, cleaning, and council tax. Structural repairs we are not taking. Out of that, council tax is exempt. So we are only taking electricity and cleaning. This is the total. In case you forgot, we can go back to activity 1. Here, electricity and cleaning. Okay, just this 2 we are taking. So now, salary. Remember, salary we have to take, and from salary we have to deduct pension contribution. This is an allowable expense we have to deduct. So salary we deduct, and then other benefits we add. This is your net. This you have to calculate. Net emoluments. Take 10% of it. It is this. So 10%, and it has to be lower of. Remember the lower of cost and this ancillary benefits. It is lower of this or this. This. So your net emoluments in this, cost is this, lower is this. So if you take the total, it is still this. This is the accommodation benefit. Now, moving on to a third benefit, that is vehicles and fuel. When a vehicle is given, obviously vehicle will run with fuel, so both are given together. They are complementary with each other. Now, first we'll go through cars, then we'll touch the van. So company cars. Okay, if you are given a private use of a company car, it's a benefit for you. It will be tax on the employee. Remember, this is not on a pool car. You are individually using the car alone. So private use means you are traveling from home to workplace. Okay, how are you going to get the car benefit? And remember, this is very crucial because most of the time if you take all the benefits of the list and check, company cars and fuels benefit. This is a very common benefit. This benefit has a higher frequency of appearing in your tax and ATX exam. I don't know the reason, maybe examiner wants it or they like this benefit, but this has a very high chance of appearing. So make sure that you know all the rules, and this is pretty much easier compared to the other benefits, okay? So you just need the car benefit percentage based on the list price. On the list price, you will take the percentage, okay? Less any contributions that an employee makes towards the car. This is how you have to do. Get the relevant percentage into the list price of the car, employee's contribution, deduct, and the taxable benefit. The percentage that you have to use will vary according to the emission of the car. Now, this table will help you a lot to understand. Okay, so your relevant base level is 55. You have to see whether it is a diesel car or a petrol car. Okay, so if it's a diesel car, see, petrol car and diesel car meeting RDTO standard with CO2 emission up to this 51 to 54 grams, it's 15%. You have to apply to the list price. If it's beyond 55, it's 16. Most of the time they will give you the second criteria where it is more than 55. Okay, the percentage for electric car with zero emission is 2%. This percentages, in case you forgot, it's okay, will be given to in the exam. And hybrid cars with CO2 emission between 1 and 50. This is the range. So they have given you the electric range 130 miles or more, 70 to 129, 40 to 60, and 30 to the and less than 30. Lesser the miles, greater the percentage. The miles keep reducing, percentage keeps increasing. Okay, now, so the base percentage, if you see, it is 16. Starting is 16, so the base is 16, and this will rise in 1% steps for each 5% above the base 55. So anything above 55, okay, it will increase by 1%. Maximum this percentage could increase is 37. Remember, if it's 39, still you will take 37. If it's 40, you will take 37. If it's 37, you will take 37. But if it's 36, you will take 36. Okay, there's a 4% surcharge for diesel cars which do not meet the RE2. Remember, diesel cars meeting RD2 standard is same as petrol. But diesel car not meeting RD2, there will be 4% surcharge. 4% surcharge means whatever the rates given here in this table, just add 4% with it. That's it. Okay. So the percentage including the lower rate of 15 are increased by 4% for diesel cars which do not meet the standard. This is also maximum 37. Whether it is diesel car meeting the RD2 standard or not, maximum, even petrol, maximum is 37%. So for example, 1% addition. Let's say your CO2 emission is 144. Okay, this is how it works. This is 144. This is between the two 5-gram increments. It falls between 140 and 145. Always round down to the lower amount. Round down, not round up. So 145, even though it looks closer to 145, but you have to round down because this is the rule. It's a fixed rule. Remember this, round down. Do not ever go and round up. So 144 means it's 140. Okay, this is how it works. Example 1 will help you. See, at 55 it is 16, right? If it's more than 55, let's say 152. So you deduct 152, deduct 55 from 150. See, 152, first you have to round down. They will always give you a figure which is not divisible by 5. You have to round down to the nearest 5 grams. So it's 150, so that you get a whole number. That's why the main idea is they want you to get a whole percentage, not in decimal. That's why I have to round down. So 150 always minus 55, always divide by 5. This is fixed. Only this 150 keeps changing. So what is that? It's 19. What is your percentage? Is 19%. Whatever the number you get, that is your percentage. With that, you should always add with 16. This is your base level. When is more than 55. So 35. It did not reach the maximum 37, so it's 35. Remember, this was a petrol car. If it was a diesel car, add 4% with 35. It becomes 39. But remember, the max is 37, so it is restricted to 37. It can't go to 39. Now, manufacturer's list price. So in the list, this is how you have to calculate the list price. It's very important that you get correct with the list price. Otherwise, your car benefit will be wrong. You might get the percentage correct, but if your list price is wrong, still benefit will be wrong. Why? Because that percentage you apply to the list price. Okay, so that list price is the cost of your car at which you are buying it when it's new. Okay, anything extras you are buying, that also you can add. So optional extras bought later, if it's 100 or more. If there are capital contributions made by employee towards the purchase price of the car, remember your list price will reduce by that. It will reduce by lower of the contribution and 5,000. That means max you can reduce the purchase price. The list price is by 5,000. It cannot be more than 5,000. Now, annual contributions. If there is any annual contributions made by employee towards the private use of the car, excluding specific payments for car insurance, this will reduce your taxable benefit. Remember, annual contributions should not be confused with your capital contribution. Because if you are making capital contributions, it is directly deducted from list price before even you calculate the benefit. But annual contribution, it will reduce your taxable benefit. If an employee is provided with two company car, remember each car, you have to see their CO2 emissions and then their list price separately. You can add the two purchase price of the two cars. Next, the availability of the car matters a lot. If the car is unavailable for any time during the tax year, your taxable benefit will reduce. Proportionately, you have to reduce it. Okay? If it's unavailable for a continuous period of 30 days or more, if it's less than 30 days, you don't count it. But if it's 30 days or more, it was unavailable, then you have to reduce it. What about the pool car? Pool car, as we saw in section 1.2, is an exempt benefit. Pool car is a car which is used more than one employee. Okay? Now, example 2. So, example 2, there are 4 different people: Daniel, Jessica, Akim, Lorenzo. So, you have to calculate their benefit. Daniel is having a diesel car. He's using it throughout. List price is 20. CO2 emission is 116. Above 55, you have to do that calculations. And it meets the RD2 standard. Same as the petrol. Jessica, hybrid electric company. List price is 30. Official is 29. And electric range 129. Akim, new petrol. Throughout. List price is 33. CO2 emission is 175. Paid for capital contribution 3000. Lorenzo, new diesel. This is given on 6th April. Remember, it was not used for the entire year. You have to reduce it. List price is 18. CO2 emission is 122. Does not meet RD2 standard. Pays a monthly contribution of 100 towards the private use of the car. So now we will be calculating the 4 people's benefit. So let us quickly do example 2. So now we'll find for Daniel. Okay. The benefit for Daniel. So the list price was 20 and 160. Now we need a CO2 emission. It's a new diesel car. meeting the RD2 standard. That means we can use the same percentages as a petrol diesel car. Petrol. So it's 116. Remember, we have to round down to the nearest 5. So 116 will take 115. Okay. So this is down here. Okay. So it is equals to 115 minus 55. This whole thing divided by 5. It's always divided by 5. So it's 12%. Okay, we'll take this in terms of percentage. We will take uh, okay. So this is 12%. Now, since this is a diesel car, if you go here, you see this is a new diesel company. It's a diesel. So because it's diesel, will 4% be added or not? 4% will not be added because it meets the RD2 standard. It is the same as the petrol. So it's 12%, but that 12% you have to add with the 16%. 16% is the base because 16% is at 55. So now you will be adding it with 16. If you take the sum function, it is 28% you have to take. And what is the price? List price. There is no capital contribution to be made, no nothing, only 20,000. So it's 20,000. So here if you take it is 20 into 28%. So the benefit is 5,600. This is for Daniel. Now let us move to Jessica. So for Jessica, it's a hybrid electric company car, and you are using it on from 6th June. So you have to time a portion. How many months? April and May. 2 months it is not there. So it is there for 10 months from 6th June 2024 to 5th April 2025. So for how many months? 10 months you are using it. And because it's hybrid electric car, you have to use this table. What is the mile? 129. It is 129. So you have to, so the percentage is 5%. Okay. And the car has a list price of 30,000. So for Jessica, the relevant percentage is what? 5%, and is for 10 months. So straight away, it is 5%. This price is 30,000. So when you're taking it, it is this into 10 months. 10 divided by 12. 1,250. This is the benefit for Jessica. Coming to Akeem. This is new petrol car. List price is 33. Rate is 175. Already it is 175. You don't have to round up or down. Capital contribution is free. So you have to deduct from the list price 33. You have to deduct 3,000 because it's less than 5,000. So for Akeem, remember it's 175, right? So 175 minus 55 divided by 5 is 24. And you have to add with 16. So if you take, you see, it's 40. You can't take 40% because the maximum is 37%. And from your 33, you have to deduct 3,000, the capital contribution. So 33,000 minus 30,000 into 37%. This is the benefit for ACCA. Wait, it is 33 into minus 3,000, not 30,000. Now we are moving on to Lorenzo. So Lorenzo, new diesel car, does not mean RD2 standard. So that 4% surcharge is there, and it's there from 6th September. So for how many months? It is there for 7 months, from September to 5th April 2025. Okay, this price is 18,000. And Lorenzo pays the company a monthly contribution of 100 towards the private service car. So remember, the contribution that Lorenzo is making will be deducted from the taxable benefit. Now let us find the percentage. This is 122, you round down. It's 120 minus 55 divided by 5, 13. And with this 13, we will be taking 16. Because it is a diesel not meeting RD2 standard, we will increase it by another 4%, which is 33%. Okay. So it is, list price is 18,000 into 33% into how many months? 7 months. 3465. And remember, once you get this, from here you will deduct his contribution, Lorenzo's contribution. 100 monthly contribution. How many months? 7 months. So 100 into 7. It is 700. So take the sum function and deduct this 2. This is the answer, 2765. So these are the answers that we have just done. For Daniel, we have got 5,600 as taxable benefit. For Jessica is 1,250. For Akim, it is 11,100. And for Lorenzo, we have 2,765. Now we are moving on to the next benefit, that is vehicles and fuel. So fuel, we have done with car, now fuel. This also is a taxable benefit, and for the tax here, it is fixed 27,800 with the CO2 emission percentage that you have used for the car. It is the same CO2 emission. Okay, and if it is provided for part of the year, then the benefit is prorated. This is very simple. Okay, no, there will be no fuel charge if the full cost of the fuel is reimbursed by the employee. Then no fuel charge will arise. If employee pays for the full cost, there's no charge on employee. But if an employee reimburses only part of the fuel, then that reimbursement is ignored. It is fully taxable. So no partial contributions are accepted for fuel. It has to be either full or nothing. Now, so the base value for the fuel benefit, that is 27,800, this is given to you on the exam. Now let us do activity 4. So here, from 1st Jan, she is employed. She is being offered the company car. List price is 15, but she chose a car with a list price of 21 and personally contributed additional amount of 6,000. 500 of optional extras were fitted after delivery. CO2 emissions 155. Company paid for all running expenses including petrol. Now you have to include the taxable car and fuel benefit Let us do that. So now we will be solving activity 4. Okay, we want the percentage. So first we are going to get the percentage. Now if you see, this is 155 grams. So you don't have to round down. You can just take 155. Okay, so I will show in the previous working itself 155 and deduct 55 and divide by 5, which is 20. And this 20 will be added with 16 and hence 36. So 36 is the percentage. Now, list price. Remember, when you are making a capital contribution, you have to adjust the list price. So now, the list price is 21,000. But there were some contributions that was made. He has made 6,000 contribution. Remember, you can reduce the capital contribution, the lower of 5,000 or 5,000 and the employee's contribution. So in this case, 5,000 is lower than 6,000. So from 21,000, you can deduct 5,000. Okay. So equal to 21,000 minus 5,000. Now, you have to add the cost of extras, that is exceeding 100. So it's 500. You have to add 500 because it's more than 100. So it is 16,500. Done. So now your list price is 16,500, percentage is 36. You have to take the number of months, for how many months it was there. It was Jan, so it's only there for 3 months. Jan, Feb and March, 3 months. Okay, so the car benefit is this multiplied by 36% multiplied by 3 months. It is 1485. Remember, this is only the car benefit. You need the fuel benefit as well. This is car. And car and fuel you have to add. And you need this 36% because if you don't get this correct, your fuel benefit will be wrong because it's based on that percentage. So now it is 36 percent multiply by, it's fixed, 27,800. And this also you have to apportion for 3 months. And then you take the total of this two, the car and the fuel, that is your total benefit. So this is the answer for activity 4, where we have added both fuel and car benefit and got the total. Now, next benefit is for vehicle and the fuel. So from car we are moving to company van. Okay. If the private use of company van is insignificant, then the private use benefit is an exempt benefit. But if the private use is not insignificant, then the cash equivalent is 3960 per year. This is fixed. And in this case, for company vans, CO2 emissions are irrelevant. But if vans are giving zero CO2 emission, they have a zero benefit charge. Now, The fuel. So this is the fuel for company vans. Fuel for company cars and company vans are different. If you see the figure. So the provision of private fuel, the cash equivalent is 757. Okay. As for car, there is no fuel benefit if the full cost of the fuel is reimbursed by the employee. Then no fuel benefit will arise on employee if employee pay for the full cost. This is for the fuel for van as well as for car. It's the same rule. Now, there is no fuel benefit if they produce zero CO2 emission. Even for the fuel, there is no benefit if it's a zero CO2 emission. The scale charge and the fuel benefit are included in your tax rate in your exam. They'll be given to you in your exam. Now, the next benefit, loans and loan interest. First, loans written off. Okay, when an employer is making a loan to an employee, see, the loan itself is not a benefit, but it will be a benefit if your repayment is forgiven by your employer. Employer now says no longer to repay the loan, you are forgiven. Then it becomes a benefit. Okay, so in this case, the amount of loan that is forgiven is your amount, taxable benefit. But we are more focused on the loan interest part. Okay, here when an employer is giving their employee a loan at a lower interest than the official rate is 2.25%. So it's a benefit for you because you are receiving a loan at a lesser price than the official rate. Okay, so in this case, on two alternative bases you can calculate the interest benefit. Number one is known as average method. So this is how you calculate the average method. L1 plus L2, that is your interest. You add both the loan. If there are two loans, you add divide by 2 because there are two, and into average official rate of interest. So L1 amount outstanding at the beginning, L2 amount outstanding at the end of the tax year. And the second method is known as precise method, where interest are calculated on day-to-day basis. Okay, so for this refer to activity 5 solution. Now, here both bases you have to consider if a loan is being repaid. Even though your precise or strict method is calculated day-to-day basis for your exam purpose, it is done on a monthly basis. Okay. Now, official rate 2.25% will be given to in your exam, so you don't have to worry. Now, activity 5. So, we will be solving activity 5 where we have to calculate the benefit on the beneficial loan and conclude which method is more beneficial. Of course, the one which is giving you the lower benefit. Okay, so here employee is earning 30,000, borrowed 26,000 in Jan 2024 at a rate of 1.5, which is below the interest rate, full official interest rate. Now the full amount of the loan was outstanding on 6th April. Date repaid 8,000 on 1st July 2024 and paid interest to his employees 250. So now we'll calculate the assessable benefit. So let us solve activity 5 using the normal method first, that is the average method. So first we'll find the average. What is the amount of the loan at the start of the tax year? 26,000. And at the end of the tax year, he has repaid 8. So from 26, if you deduct 8,000, it is 18,000. Okay. So it would be equal to 26 at the beginning of the year plus 18,000. Divide by 2. So 22,000. Now on this you have to pay interest at the official rate 2.25%. So this into this. Now you are going to deduct interest that you have actually paid. You have paid interest at 1.5%. So just write this down. So now remember interest actually paid is 250. Okay, it's minus 250. So just do the sum function. Done. It's 245. Now we'll move to the strict method. So when are we repaying it? This 26,000 Jan, right? So the full amount of the loan is outstanding on 6th April. How many months? See, 26,000 will be outstanding from 6th April 24 to June, because on 1st July you are repaying 8,000. So you are counting April, May and June, 3 months. So you will be paying 26,000 for 3 months at 2.25%. Okay. So here it is 26,000 into 3 months from April to June at 2.25%. This will round. Okay, so I'll go here, custom, all, 0. Okay, it's 146. Next amount of loan. You are repaying 8,000 on 1st July. So from July to April 2025, how many months? The remaining 9 months. So it will be 18,000. After you repay 8,000, 18,000 into 9 months into 2.25%. This also I'm going to round. Custom. Okay. So just perform the sum function and deduct 250, the amount actually paid. So if you see, this is giving you 200, this is giving 245. So you will go by the strict method. Okay. So these are the answers. Under normal method we got 245. Strict method is 200. This is lower, so they will go by the strict method. Now moving on to what about amount of loan which does not exceed 10,000. In that case, there are no interest benefit when your value of loan does not exceed 10,000. If it's less than 10,000. So a practical example is a loan for the purchase of an annual travel ticket. Let's say you are taking a loan to purchase a ticket, to purchase an annual travel ticket for regular commuters. So this is an example where your amount of loan might not exceed 10,000. In this case, because the amount of loan is less than 10,000, there are no interest benefit also on that loan. Now, where a taxpayer has several assessable loans, that means there are many loans that a taxpayer has taken but from the same employer. Remember, this 10,000 exemption will see the reference to the total of all the outstanding loans. Let's say from your employer you are taking loan 3 times. Once you are taking 2,000, next time you are taking 3,000, then you are taking another 3,000. So 2 plus 3 plus 3 is 8,000. It does not, the three loans taken by the same employer in the tax year does not exceed 10,000. So that is exempt. But if it exceeds 10,000, the total I'm talking about, not one single loan. If the total of all the loans exceed 10,000, then you are going to have an interest benefit. So it will be taxable. Taxable interest benefit will arise on each loan in all the three loans. Okay, not just one. Then the exemption will not apply. Example 3 will help you to understand this better. Now there are two interest-free loan. Interest-free loan means no interest at all. He is taking from his employer. One is 6,000, loan 2 is 8,000. If you see, individually each loan is less than 8,000. 6 and 8. But if you add them together, it is 14,000. So it is not exempted. Now both the loans will give rise to taxable benefit. So you have to take 2.25 on 6,000, that is official interest rate, and 2.25 on 8. Now 1.10. Next benefit. When you are using assets, but those assets are not your vehicles, fuel, accommodation or loan. Other than that, any other asset. When it is made available to an employee, but the ownership is with the employer, it is a taxable benefit in the hands of employee. So the benefit is the greater of these two. 20% of the market value of the asset when first made available, minus any contribution employee makes towards it. Remember, in almost all of the benefit, if an employee makes a contribution, you can deduct, except one area, that is fuel. There, employee has to fully contribute, otherwise no. Partial contribution will not be taken. Okay. Or the rent or the higher charges the employee pays for the asset. If an employee has taken something on rent or hire purchase, so the rent or higher charges that an employee is paying, that you have to see whichever is the two, which two is greater, the asset's annual value or the rent that employer pays. Whichever is greater, that is the benefit. This amount also should be prorated if asset is not available for the full year. Now, what about the private use? Occasionally you have a private use, right? Let's say a computer. So the occasional private use of a computer by the employer for work purpose do not give rise to a taxable benefit under this rule. Remember, you have to actually use the asset. Occasionally, if you are privately using the computer, that will not give rise to a taxable benefit. It is not a benefit. It's not a taxable benefit. Now, transfers of used assets. Remember, use of assets and transfer of used assets are different. So here, type of assets and what is their cash equivalent value. All assets will fall here except motor vehicles and computer equipment. Then cash equivalent is higher of market value when first made available, less any annual use benefits to date. Because it's a used assets, you must have some benefit to date that was accessible, that was access to tax. You have to deduct it from the market value or the current market value, whichever is higher. Remember, if employee is paying towards it, you have to deduct it. Next, motor vehicles and computer equipment. If you are transferring this to, then cash equivalent is the current market value. Less, again, if an employee pays towards the asset, deduct it. So activity 6. Let us do activity 6 to understand this better. Now, use of assets is also another very popular benefit which often appears for your tax. So be prepared for this area as well. So Rodney is having a salary 40, is being provided with a new camera by his employer. Remember, this is not a motor vehicle, this is not a computer, it's a new camera. So it will fall in the first one, higher of the two things. When on 6th October 2022, costing 2,000. In the first one, you have to show the benefit. If immediately employee transfers the ownership to Rodney on this date. Second, show the benefit if he had used the camera until 5th Jan 2025. when ownership was transferred to him for a payment of 100, when the market value was 500. So now, transfer when it is new. Okay, what is the cost to the employer? It was 2000. Okay, transfer when it's new. Cost to employer 2000. Next, use of asset and then you are subsequently transferring it. Now, here it starts from which tax year? 22-23. So 2022-23, 2023-24, 2024-25. What is the amount? 2000 multiply by 20%. You have to take 20% of the value of the asset into how many months? It is October. So from October to April, if you take it is 6 months. 200. Here it would be simply 2000 into 20% for one whole year. So it's 400. And here 24-25. If you are taking again, so here now so when you complete 24-25, what happens? It is from April to Jan. See, here it is 6th April 2022, 6th April 2022 to 6th October, sorry, 6th October, I'm sorry. 6th October 2022 to 5th April 23. It is this. Now here it is 6th April 23 to 5th April 2024. 1 year. And when you come here 6th April to 24 2. What is the date? 5 Jan 2025. 5 Jan 2025. How many months? If you calculate, it is 9 months. So this you have to take 20% of 2000 into 9 months. 300. Now we'll take the sum of all the three. 900. Now come into this tax year. Transfer benefit. What is the transfer benefit? We have to work out. So transfer benefit here will go working here. It is higher of market value. What is the market value at the date of transfer? They have given you 500. And original market value less annual use benefits assessed to date. So originally assessed to date is 900 and the annual value, the original market value is 2000. So here it is 2000 minus 900. Which one is higher, this or this? It is this which is higher, 1100. So this is the benefit that you have to deduct. So it's 1100. From here you have to deduct contribution by employee. Remember this. This is the benefit when you're transferring use asset. It is the greater of this two. So we have got this 1000. From here you are going to deduct the employee's contribution. So employee is contributing 100. So you deduct 100. Okay. So it's 1000. So now what happened? What is the taxable benefit? The taxable benefit is this plus 300. It is this plus 300. Done. Why this? This is for 24-25 and this is for 24-25. We want for 24-25 only. To reach this stage, we need all the previous figure. Because we need this information. If we don't get this 900, this will be incorrect. If this is incorrect, we will not get this figure. Understand? So with this, we'll add 24-25 figure. And hence, the benefit is 1300. That is your taxable benefit. So finally, this is the answer for it. Transfer when new. This is the benefit. Use of asset and then subsequently you're transferring. So for 3 years we have found out, and this one we have got from here. What is the benefit when you're transferring? The used asset is the greater of those two. Deduct employee contribution and add with 300 because it is for this tax here, and then you get your taxable benefit 1300. Now, so we are moving on to the second part of this lecture, and that's it. We have finished all the benefits. Keep in mind this benefit because when you go to ATX later on, this is going to help you a lot. Pay as you earn. So what is the scoop? Employees. Okay, mostly it is employees. Why? It will impact them. Why? Because their income tax and their national insurance contributions are deducted at source from their income. And this deduction from their source of income is known as pay as you earn. The moment you earn it, it's paid. So under PAYE, what are done? Your income tax and class 1 NIC are deducted. From your employee's remuneration, these two are deducted by employer, and your income tax and NIC together with class 1 and class 1 NIC are payable by employer. Income tax, NIC, your class 1A. Class 1A is for the benefit that we have just covered. On that there is an NIC, and class 1 NIC, it is on your earnings, cash earnings. These are payable by whom? Employer. And it is regularly accounted HMRC by the employer. And not only that, employer has the obligation, they are obliged to make a full disclosure of an employee's remuneration to HMRC. And employee's remuneration should include the taxable benefit as well, not just the cash, not just your salary. Now, next, tax collection at source. So the tax that is collected under PAYE, what is the main aim? The main aim is they want to collect the tax so that it corresponds with the correct total tax liability for employees. So, through the use of an appropriate software, okay, there is a notice of coding. Your tax will be deducted at all rates after applying an individual's personal allowance, appropriate tax reliefs, and even taking into small amounts of the taxpayer's investment income. So many employees with simple income, they will pay all their tax at source. Most of their tax will be deducted at source only. This is for employees. So that means employees should not do a full income tax assessment. System is not required actually for employees, unlike self-employed people. Now, so this tax collected at source, this is based on the information that is supplied by the annual employee's annual tax return. Okay, each employee will be sent a notice coding that sets out what are their allowances and reliefs. For example, what is their personal allowance, their allowable interest paid, expenses that can be deductible. Then, what is the tax value of their employment benefit? For example, recurring employee benefits. Some benefits are recurring, like car, fuel, and small amount of investment income on which it is convenient to discharge the tax liability by setting off against the allowances. So, avoiding collection by self-assessment. Adjustments to cover tax underpaid in the earlier tax years. Based on this, there will be a coding notice sent to you. Now, code number. See, all these are important for your MCQ. Otherwise, you don't have to. This will not be asking ATX. Okay. How a code number will be used by the employer to determine the amount of the employee's pay that is tax free. So normally, value of your allowances and the relief exceeds the tax value of benefits, investment income, and your prior year underpayments. So from the net allowance figure, let's say 3099, we drop the last number. So we drop the last number and we add a letter instead of that place. So from 3099, if we drop the last number, that is 9 cutoff, we are left with 309. With this, now we'll add a letter. Okay, so that is your code number. Now, this code number usually have a suffix letter that allows both HMRC and employer to categorize their employees according to the personal allowance. The most common suffix is L and indicates employees entitled to basic personal allowance 12,570. In practice, this allows employees to adjust the coding without the prior, so you can adjust the coding without priorly getting the authorization from HMRC. When the personal allowance is upgraded each tax year. Now, if the tax value of benefit exceeds your allowance, you are going to have a negative tax code. These codes will be prefixed with the letter K. And for only K code, 1 is deducted from the final code number. So application of a K code means that an amount is added to gross pay for pay purpose to ensure that benefits are taxed at source. You don't deduct, you add. Now, where an employee has not been allocated a tax code, let's say an employee does not have a tax code, what do? How do employer identify them? In that case, employer can give them an emergency tax code. Emergency means which is only their personal allowance. In this case, what is the personal allowance? 12570. So it would be 1257. Drop the last digit and just put an L, which is very common. So 1257L. until there's a correct tax code issued to the employee. Employer is not given the details of the coding notice. Only the code. Employer only given the code number. So now let us do this example 1 to determine the code number. Your personal allowance, you add your expenses. Remember both are allowances. So you add and you get deduct your taxable benefit. Okay, so this drop down the last digit. So it's 865 and just put L. Now, weekly or monthly procedure, the real-time information. So at the end of each tax week or month, the employer will use the payroll software to calculate the tax and the NIC. This is done monthly or weekly. So here, employees are required to report pay each time payment is made to employees under the real-time information. So when should they do this? They should do it before the date payment or on the day the payment is made to an employee. And also you have to report to HMRC that. So reporting to HMRC must be returned in full payment submission. Either you are using the employer's payroll software or through a payroll provider. So apart from very few exceptions, we don't want to know the exceptions. This requirement applies to all employees, from large multinational to your domestic staff and nannies. Now, so your tax and NIC, which is collected by employer, this has to be paid to HMRC within 14 days at the end of the each tax month, or 17 days if paid electronically. Remember, each tax month runs from the 6th of the month to the 5th of the following month. That's how 6th April to 5th April. Okay, so the payment, if you add 14 with 5, it is 19, or 17 with it, it is 22, paying electronically. So the payment is due by 19th day of each month or 22nd if paying electronically. Employers with more than 250 employees must pay electronically. There is no option for them. If your average monthly liabilities do not exceed 1,500, then you can do a quarterly settlement. So these are the quarters: 5 July, 5 October, 5 Jan, 5 April. You have to remember those dates when other quarters. Very important, the due date. Now the pay penalties. What are the penalties? If you are submitting it late, penalties will be charged. But no charge for the first late submission. So first time you are paying late, there is no penalty. But after that, but any further default can be charged a penalty based on the number of employees. So this is based on the number of employees will be charged a penalty. If it's 1 to 9, 100. Monthly, okay, this is per month. 10 to 49 employees, 200. 50 to 249, 300. 250 or more, 400. Also, if the submission is more than 3 months late, then there is an additional tax-based penalty. This will be charged 5% on your tax and NIC. This addition to this monthly penalties. Year-end procedure. So these are your year-end reports and form P60. You need this for MCQs, by the way. This information. So this could be made on or before the last payday. Employer should make a final submission to HMRC. So after the tax year end, which is 5th April, your gross pay, your tax, your NIC, this will be deducted for each employee and it will be shown in the form P60 and given to employee. What does P60 do? This is a form that shows employee's final tax code. It shows the employee's name and address. These forms are to be provided by 31st May after the end of the tax year. That means for 24-25, it will be by 31st May 2025. Remember these dates, very crucial. Then next form, Form 11D. This is Employer completes it for each director and employee who has benefits. Remember, if you are not having taxable benefit, you don't need this form. It is only for taxable benefit. And this is for those that are not already reported under real-time information. So it shows the taxable value of your general expense, traveling, entertainment, benefits, this three. Okay, so form P11D shows this three. And what is the due date for the completion of this form? 6th July following the end of the tax year. So 6th July 2025. Employee has to be given a copy. See, who is completing this form? Employer. Therefore, employee also has to be given a copy of this so that they can complete their tax return. Now, moving on to payrolling the benefit. Okay, employers now have the option of payrolling most benefits, in which case, remember, your values, your benefits will be included in your taxable pay, and this will be collected under PAYE, like how salaries, tax on salary is deducted. Okay, so employees wishing to payrolling benefits, remember, you should register with HMRC before the start of the tax year. Allowing the payroll benefits to be removed from the employee's tax coding. You have to remove it from employees form 11D because now you are payrolling the benefits. All benefits you can payroll except vouchers, credit tokens, living accommodation, and beneficial loan. By the way, this benefits we have just covered in the first section of this lecture. So except these 4 benefits, rest all the benefits could be payrolled. If an employee benefits are all payrolled, you don't need the form P11D because it includes all benefits. But if all benefits are taken as pay, you're payrolling, no need of the form. Why to unnecessary use the form? Now, employees who change employment, for them what do you do? When an employee leaves an employment, there is another form, that is P45. HMRC will be informed under the real-time information, but employee will be given a form P45 where their total pay and tax that has been deducted before leaving will be shown. So what happens because of this form? Your new employer can use that information to carry on deducting your tax as if there have been no change of employment. In some circumstances, a new employee may not have a valid form P45. See, if you are a new employee, you are working for the first time, fresh, you will not have this form because you don't have any previous employment. So in the absence of this form, your new employer, from where will they get the information? They must gather all this information. Okay, so all the starting information they have to gather. Now, so that's it for this lecture. We have finished both the income tax and the pay. Now it is from your section B, income tax, income from employment section. Here we explained the pay system, how it works, how the benefits could be payrolled, and the purpose of P11D. Then we calculated all the benefits and recognize the circumstance in which real-time reporting, late filing penalties will arise. So now let us summarize the lecture. There are a variety of benefits that are exempt. Job-related accommodation is treated favorably for tax purpose. Then company car. Remember, company car benefits are based on 2 things, list price and the percentage. This percentage is based on your CO2 emission. And capital deduction you can make max 5,000. This is deducted from list price. And then fuel benefit. For fuel benefit, if an employee contributes, only if an employee contributes fully, there will be no benefit that arise. Otherwise, partial contributions are ignored. Then loans, if you are taking from an employer. If you are writing off a loan, they will be taxable. And what about the interest benefit on the loan? Interest benefit means when you are given a loan at a lower interest than the official rate. This is a benefit for you and it will be taxable. There were two methods that we used to calculate the interest benefit: average method and the daily method. Now, assets made available for private use, you have to use 20% of the market value, less any contributions made by the employee. What is the cash equivalent when you're transferring the used asset? Higher of market value when first use, less any annual use benefits to date, and the market value at the date of transfer. Tax collected under PAYE accounts takes account of the personal allowance, your tax relief, taxable benefit, and underpaid tax. Remember these four things. And underpaid tax, you have to gloss it up. Okay, this will be summarized in your coding notice. Then, payee forms that need to be used by employers. P45, this is when an employee stops working. P60, this is your summary of pay and tax. P11D, this is for all your benefits, unless you have paid all the benefits. In that case, you don't need P11D form anymore. So the technical articles that you have to read for this lecture, yes, there are technical articles. You have to go online from your ACCA website and benefits. These are relevant for your exams for June, September, December and March 2026, up to March 2026, known as benefits. The next chapter, technical article, is cars. So benefits and cars. These are the two technical articles you have to read. So thank you for watching and I shall see you in the next lecture. And meanwhile, do not forget to subscribe to my channel if you haven't subscribed yet. You can also join my channel and become a member so that you can watch my ATX lecture, which are there under my membership. Thank you.